So hello everyone. I want to discuss the modified Dietz method of calculating your personal rate of return on your portfolio. Many times the question comes up, how have I done on my portfolio with regards to my personal rate of return? Now, a lot of companies will give you your personal rate of return. So for instance, I have TIAA-CREF for my retirement portfolio, and they calculate your personal rate of return, and they use what's called a modified Dietz method, and so do a lot of other companies. So let me just read this to you. So the personal rate of return, short abbreviated PRR, is estimated in order to provide you with useful information in a timely manner. We use a methodology called the modified Dietz formula, which takes into account your cash flow during the specified time period. To get the precise return, we have to compound the returns over every period that involve the cash flow. The methodology we use assumes the return for the entire period is also the return that applies to each sub-period following the cash flow. It's common among investment companies that provide this type of performance measure. As a general rule, the larger your cash flows are, the larger the variance between your estimated rate of return and your actual rate of return will be. So this is basically your estimated rate of return here. You notice how they use the word estimated, and here they use the word estimated. So what I want to do is go into some detail here from different articles I have. So here's one, right, that basically says how to calculate your modified Dietz rate of return, and they refer to it as an approximate time-weighted rate of return. Now, what we're going to learn is there's two methods that are used to calculate rates of return. Well, there's a lot of different calculations, but the two most common are time-weighted and money-weighted, okay? So the modified Dietz is an approximate time-weighted rate of return, and there's a lot of argument about that, by the way. And it's abbreviated MDR. And this particular company, PWL Capital, uses that. It attempts to estimate a true, and you see it says a true time-weighted return, rate of return by weighting each cash flow by the proportion of the measurement period it is present or absent from the portfolio. Monthly modified Dietz rates of return are usually calculated and geometrically linked together, similar to the process we saw above with the linked internal rate of return. This is a great article. It has many rates of return, by the way. Since the portfolio is valued monthly and not daily, the modified Dietz rate of return can still differ widely from the true, time-weighted rate of return if large external cash flows occur during volatile monthly measurement periods. They echo what you saw in the other one. So just wanted to show you. Here's the equation for the modified Dietz rate of return. And if you look at each one, this is the full market value of the portfolio, okay, including accrued income at the end of the period. And this is the full market value, including accrued income at the beginning of the period. And basically, CF is the sum of the cash flows, okay? You can see what CF is. It's the sum of the cash flows, okay? And WI here is the weights of the applied to each cash flow. And how did they determine the weights? It's the total number of calendar days minus the number of calendar days from the beginning of the period that cash flow CFI occurs, okay? And again, they divide it by the total number of calendar days. So this will give you the weight, which gets put in here, which you multiply by each respective cash flow, okay? And basically, this here is the sum of the cash flows that you're subtracting out, right? You don't want the cash flows to affect your calculation. What you're trying to do is see how your portfolio manager is running your running your portfolio without you basically causing the number to be skewed, because you got money going in and out. Okay, so you don't want your money going in and out, your positive and negative cash flows, to skew the number. You want to judge him on his performance only. Okay, so there's a nice example here, and they show you the different weights being calculated. Okay, so February 1st to February 28th. Okay, and here's the weights. Okay, and again, here they calculate weights. So you can see, here's the if you look at the equation here, this is the total number of calendar days in February, right? 28, and I guess they assume the payment goes in on the 14th in this example, and that's DI, right? Which is the number of calendar days from the beginning of the period that cash flow occurs, divided by the days in the period, again 28. So you get the weights. Here's the weights, and here is the contribution, right? That went in. Here's right. So here is the money, so here's a 2%. And then basically money went in here, and then money went in here, right? And you have three calculations here, and then you just simply geometrically link them. Okay, as shown here, you take these three numbers and use a geometric link, which is you just add 1 to each number. Notice how they're adding 1 to each return, and you subtract 1, and this gives you a modified Dietz from January 1st to March 31st of 7.67%. Again, that's an estimate. Okay, so I just wanted to make everyone clear of that. So there's other calculations in this form, which we'll go over in time. But again, let me show you some other documents. And this is another nice document, and it's called The Confusing World of Modified Dietz. So in the past, I've launched the issue of, I've touched on the issue of modified Dietz from the standpoint of whether it's, you can see the confusion, whether it's time or money weighted. And after much thought, reflection, and hammering by my friend Carl Bacon, have concluded that yes, it is money weighted unless we link it, in which case it becomes an approximation to the time weighted rate of return. And you can see we linked it, right? So you can see there's always confusion about this. Okay, so here's time weighted approximate, and here's modified Dietz, and here's money weighted. So it's a good article to read. So you can kind of see they were commenting. We recognize that the modified Dietz is only an approximation to the true daily time-weighted return, but we are only willing to accept a certain degree of error. So they come up with a couple different cases here, which they go over in this example. And once again, here's the equation. Here's the modified Dietz method. Here's the weights, and here's the cash flows. Okay. So again, you should go over these, and I'll show you. I believe I have another one here somewhere. So here is the American Funds, their version, and again, the benefits of using modified Dietz. It's an industry-accepted approach to calculate your personal rate of return. We use modified Dietz over other methods such as simple total return, since it takes the timing of cash flows into consideration. And again, they go through the calculation with some nice examples here. Okay, and here's a nice detailed example of modified Dietz. Okay, and then basically they do that here, and once again, you should go over these. And here's another one. There's a thing called an annualized modified Dietz. And you can see here they are linking the returns again. As we just talked about, they linked each period's returns. And if you go down here, here's the annual modified Dietz. And you can see they're linking his monthly returns. All right, so I'm going to put some YouTube videos of this discussion on here because I think it's really worth doing. And the modified Dietz is a real common method, and you should all be aware of that. All right, you'll have other stuff.
I'm going to show you. This formula is used to calculate the portfolio performance in the presence of inflows or outflows of cash, taking into consideration the cash flows, okay? For example, let's start the month with $10,000 in our account, and we're going to end with $11,000, okay? The return on investment is probably 10% if we assume the portfolio didn't have any inflows or outflows of cash during that period. But now imagine the following situation. We start the month with $10,000, and on day 15 we make a deposit of $500. On day 20 we make a withdrawal of $100, okay? And we end the month with $11,000, okay? So as you can imagine, let me just ask you this question. What do you think? It's going to be more than 10%, the rate of return, or less than 10%? I'll let you think about it. Think about this. We deposit 500, we took back 100, okay? And we ended up with 11,000 more than we started. Okay, think about that for a moment. Let's see. An extreme example. We start the month with $10,000. On day 15, we deposit $100,000 in our trading account. And on day 20, we withdrew $10, okay? And we ended the month with $11,000. So this one is very obvious, isn't it? We can say there was a very huge loss here because we had a deposit of $100,000. That's why this is an extreme example. Even though we started with 10,000 and we ended up with 11,000, it's pretty obvious that we didn't gain 10%, okay? That's the point of this formula. And that's what the formula is going to tell us, the real gain, okay? ROR states for rate of return, EMV, the ending market value. As an example, we're going to use the first case. So it's going to be $11,000. The BMV is the beginning market value, $10,000. C is the cash flows during the period, the plus 500 and the minus 200. And W is the weight of each cash flow has on the portfolio between the time they occurred and the end of the period. Okay, this sounds complicated, but it's not. I'm going to explain you right now how is this weight calculated. Okay, so basically you have two cash flows. Okay, the plus 500, which was an inflow, excuse me, and the minus 200 on day 20. So how we calculate the weight is the following. We use the CD, which is the number of calendar days during the return period being calculated. Let's use 30, a month in this case, minus the D, which is the number of the days from the start of the return period until the day on which the flow occurred. This sounds complicated, but it's very easy. In this case, it was day 15 for 500. So as you can see below, we have the W of 500. The weight of 500 was 30 minus 15, simply dividing by 30, which gives us 0.5. And the weight of minus 200 was 30 minus 20 dividing by 30, which gives us 0.333. So we already have all the values we need to calculate the rate of return. We have the WC, so we calculate them individually. 0.5 times 500 plus 0.33 times minus 200. We have already the other values, and we end up with 6.87%. Like I said to you guys, it's kind of intuitive because we deposit 500 more in our account, okay, and we only took back 100, so we should have ended up with a little bit more, okay, for a rate of 10%, okay. So this is the application of the modified Dietz formula. Hope you guys understand. And if you guys like the video, please like the video and share it. It's going to be helpful for our growth. And thank you very much for watching.
The modified Dietz method is a measure of the historical performance of an investment portfolio in the presence of external flows. To calculate the modified Dietz return, divide the gain or loss in value, net of external flows, by the average capital over the period of measurement. The result of the calculation is expressed as a percentage rate of return for the time period. The average capital weights individual cash flows by the amount of time from when those cash flows occur until the end of the period. This method has the practical advantage over internal rate of return that it does not require repeated trial and error to get a result. The cash flows used in the formula are weighted based on the time they occurred in the period. For example, if they occurred in the beginning of the month, they would have a higher weight than if they occurred at the end of the month. This is different from the simple Dietz method, in which the cash flows are weighted equally regardless of when they occurred during the measurement period, which works on an assumption that the flows are distributed evenly throughout the period. With the advance of technology in the past 15 years, most systems can calculate a true time-weighted return by calculating a daily return and geometrically linking in order to get a monthly, quarterly, annual or any other period return. However, the modified Dietz method remains useful for performance attribution, because it still has the advantage of allowing modified Dietz returns on assets to be combined with weights in a portfolio, calculated according to average invested capital, and the weighted average gives the modified Dietz return on the portfolio. Time-weighted returns do not allow this. This method for return calculation is used in modern portfolio management. It is one of the methodologies of calculating returns recommended by the Investment Performance Council as part of their Global Investment Performance Standards. The GIPS standard is intended to standardize the way portfolio returns are calculated internationally. The method is named after Peter O. Dietz. Formula: the formula for the modified Dietz method is as follows. Where is the ending market value, is the beginning market value, is the net external inflow for the period, and the sum of each flow multiplied by its weight. The weight is the proportion of the time period between the point in time when the flow occurs and the end of the period. Can be calculated as: where is the number of calendar days during the return period being calculated, which equals end date minus start date plus 1, is the number of days from the start of the return period until the day on which the flow occurred. This assumes that the flow happens at the end of the day. If the flow happens at the beginning of the day, use the following formula for calculating weight. Fees: to measure returns net of fees, allow the value of the portfolio to be reduced by the amount of the fees. To calculate returns gross of fees, compensate for them by treating them as an external flow, and exclude accrued fees from valuations. Comparison with time-weighted return and internal rate of return. The modified Dietz method has the practical advantage over the true time-weighted rate of return method, in that the calculation of a modified Dietz return does not require portfolio valuations at each point in time whenever an external flow occurs. The internal rate of return method shares this practical advantage with the modified Dietz method. The modified Dietz method has the practical advantage over the internal rate of return method, in that there is a formula for the modified Dietz return, whereas iterative numerical methods are usually required to estimate the internal rate of return. The modified Dietz method is based upon a simple rate of interest principle. It approximates the internal rate of return method, which applies a compounding principle, but if the flows and rates of return are large enough, the results of the modified Dietz method will significantly diverge from the internal rate of return. The modified Dietz return is the solution to the equation. Where is the ending market value, is the beginning market value, is the total length of time period, and is the time between the start of the period and flow. Compare this with the internal rate of return. The IRR is a solution to the equation. For example, suppose the value of a portfolio is $100 at the beginning of the first year, and $300 at the end of the second year, and there is an inflow of $50 at the end of the first year beginning of the second year. To calculate the gain or loss over the 2-year period, to calculate the average capital over the 2-year period. So the modified Dietz return is. The internal rate of return in this example is 125%. So in this case, the modified Dietz return is noticeably less than the IRR. This divergence between the modified Dietz return and the internal rate of return is due to a significant flow within the period, and the fact that the returns are large. Annual rate of return. Note that the modified Dietz return is not an annual rate of return, unless the period happens to be 1 year. Annualization, which is conversion of the return to an annual rate of return, is a separate process. The simple Dietz method. Note also that the simple Dietz method is a special case of the modified Dietz method, in which external flows are assumed to occur at the midpoint of the period, or equivalently, spread evenly throughout the period, whereas no such assumption is made when using the modified Dietz method, and the timing of any external flows is taken into account. Money-weighted return. The modified Dietz method is an example of a money-weighted methodology. In particular, if the modified Dietz return onto portfolios are measured over a common matching time interval, then the modified Dietz return on the two portfolios put together over the same time interval is the weighted average of the two returns. Where the weights of the portfolios depend on the average capital over the time interval. Linked return versus true time-weighted return. An alternative to the modified Dietz method is to link geometrically the modified Dietz returns for shorter periods. This method is classed as a time-weighted method, but does not produce the same results as the true time-weighted method, which requires valuations at the time of each cash flow. Issues. There are sometimes difficulties when calculating or decomposing portfolio returns, if all transactions are treated as occurring at a single point during the day. Whatever method is applied to calculate returns, an assumption that all transactions take place simultaneously at a single point in time each day can lead to errors. For example, consider a scenario where a portfolio is empty at the start of a day, so that BMV equals 0. There is then an external inflow during a day of F equals $100. By the close of the day, market prices have moved, and EMV equals $99. If all transactions are treated as occurring at the end of the day, then there is 0 start value BMV, and 0 value for average capital, so no modified Dietz return can be calculated. Some such problems are resolved if the modified Dietz method is further adjusted so as to put purchases at the open and sales at the close, but more sophisticated exception handling produces better results. There are sometimes other difficulties when decomposing portfolio returns, if all transactions are treated as occurring at a single point during the day. For example, consider a fund opening with just $100 of a single stock that is sold for $110 during the day. During the same day, another stock is purchased for $110, closing with a value of $120. The returns on each stock are 10% and 120 1/100ths minus 1 equals 9.0909% and the portfolio return is 20%. The asset weights we required to get the returns for these two assets to roll up to the portfolio return are 1200% for the first stock and a negative 1100% for the second. W10 100ths plus 10 100ths equals 20 100ths, say W equals 12. Such weights are absurd, because the second stock is not held short. Excel VBA function for modified Dietz return. Public function MDIETZ, D start value is double, D end value is double, I period as integer, R cash as range, R days as range, as double. Gelgier and Lamkamp January 10, 2008, dim I as integer, dim cash as double, dim days as integer, dim sum as range, dim sum cash as double, dim temp sum as double. Some error trapping, if R cash. Cells count R days. Cells count then MDIETZ equals CVERR, XLE value, exit function, if application worksheet function max, R days, I period then MDIETZ equals CVERR, XLE value, exit function. Redim cash, R cash. Cells count, 1, redim days, R days. Cells count, 1. I equals 0, for each cell in R cash, cash, I. equals cell value, I equals I plus 1, next cell. I equals 0, for each cell in our days, I, equals cell value, I equals I plus 1, next cell. Sum cash equals application worksheet function sum, our cash. Temp sum equals 0, for I equals 02, temp sum equals temp sum plus slash I period, cash, I, next I. MDIETZ equals slash. End function. The above VBA program is designed to use with Excel. Here is a Java program written for general purposes. Java method for modified Dietz return. Private static double modified Dietz. /EMV, ending market value, BMV, beginning market value, cash flow, NUMCD, actual number of days in the period, NUMD, number of days between beginning of the period and date of cash flow, / double MD equals minus 99,999. Initialize modified Dietz with a debugging number. Try. Double weight equals new double, cash flow length. If NUMCD,